If everything had fixed prices, inflation would cease to function in its traditional sense. Normally, inflation is the gradual increase in prices over time, but with prices set in stone, the typical economic adjustments caused by inflation, such as rising costs for goods and services, would not occur. Impact on wage growth and purchasing power. With fixed prices, wages would no longer be able to increase in response to rising costs of living. The relationship between wages and prices, which traditionally adjusts with inflation, would break down. This could lead to a significant reduction in purchasing power, as wages would become less aligned with real economic conditions. Supply and demand imbalances. Fixed prices would disrupt the natural flow of supply and demand. If the price of an item is kept artificially low, demand may exceed supply, leading to shortages. Conversely, if prices are fixed too high, there may be less demand, resulting in surpluses. The balance that inflation typically helps regulate would be compromised. Stagnation in economic growth. Without the flexibility of price changes, businesses might find it harder to innovate or expand. Fixed prices would limit companies' ability to adjust their pricing strategies in response to market conditions, potentially stifling competition and overall economic growth. Investment in new products or services might decline as well. Challenges for central banks and policymakers. Monetary policy, which relies on adjusting interest rates to control inflation, would become obsolete in an environment of fixed prices. Central banks would lose a major tool for stabilizing the economy. Governments would need to find alternative mechanisms for addressing economic downturns or growth challenges. Disincentives for production and innovation. If producers could not raise prices in response to increased costs, they may be less motivated to produce more or innovate. Profit margins would remain stagnant, and industries could face declining profitability, leading to reduced investment in research and development or other key areas necessary for economic advancement. Potential for black markets and unofficial pricing. In a system with fixed prices, black markets could thrive as individuals seek to buy and sell goods at market-driven prices. This underground economy would undermine the stability that fixed prices aim to create, as people would find ways to adjust prices outside official channels. Long-term effects on quality of goods and services. With fixed prices, companies might reduce the quality of products or services in order to maintain profitability. As the cost of raw materials or labor rises, businesses would face pressure to cut costs, which could lead to subpar offerings for consumers, affecting overall market standards. Global economic imbalances. In a globalized economy, fixed prices in one country could create disparities when compared to others. If a nation's prices are not responsive to global inflationary trends, it could cause imbalance in trade, leading to competitive disadvantages or inflationary pressures as exports become either too expensive or too cheap. Challenges in long-term economic sustainability. Ultimately, maintaining a system of fixed prices could undermine long-term economic sustainability. The lack of flexibility in responding to changes in demand, supply, and costs would likely lead to inefficiencies, economic stagnation, and a lack of adaptability to global financial conditions, ultimately making the economy less resilient.